It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday morning. Giving diplomacy a chance, President Trump will decide within 2 weeks whether to strike Iran. A $1 trillion pitch. SoftBank's founder Masayoshi Son teams up with TSMC for an AI mega hub in Arizona. And the big reveal. Tesla is set to launch its robotaxis in Austin this weekend as lawmakers attempt to block the operation. It's the continued push and pull for this oil market. The U.S. was offline yesterday, but Brent crude was trading. That's what you're seeing with reports originally yesterday that lawmakers are readying for a strike over the weekend on Iran from the U.S. So that's how you get this run up in crude. But then Trump says he'll give diplomacy a chance. 2 weeks, and then you get this drop over the past 2 days. We still are stronger. For the week, we're up 20.5%, headed for the biggest weekly gain since 2020. Meanwhile, for this equity market, the steepest of losses for the future market starts to ebb. Again, cash markets were closed yesterday. Futures were open for some of the trading day. They were down sharply, more than 1% at one point. So they recovered to something that looks down about 1/3% for most of the major indices. For the bond market, there is a bid coming through. Again, the last cash trading day was Fed decision day. We're looking at unchanged, though, this morning. For the most part, of the bid comes from the long end of the curve down or higher, selling. The losses coming for the long end of the curve. We did have a bid this morning, and that's changed in the last hour or so. Let's get you some stocks to watch now. With that is Bloomberg's Joe Easton. Good morning, Joe.
Hey, Danny. So Tesla shares rising today. It is all about these robo-taxis, as you mentioned. A couple of reports out on this unit of Tesla. Potentially, they are going to be launching next week. It is hotly anticipated, but also a group of lawmakers over in Texas actually saying that these should actually be delayed due to some safety concerns. We'll wait to see whether this progresses, but there's that quote from those lawmakers over in Tesla. I don't think these are actually taxis, though. They are just cars. I'm not sure why we call them taxis. But moving on, we've also got Circle Holdings. This one gaining as we recently saw the approval of a stable coin over in the US, so down in the crypto space. It's a second big day of gains following the move that we saw on Wednesday before the closure yesterday. So that one up 14% today. And then finally, just here in Europe, Eutelsat, this is a rival to Elon Musk's Starlink satellite company, soaring as it gets around €1 billion in funding, including from the French government. And as usual, check out the Before the Bell opening wrap on the terminal for a fantastic wrap-up of all of these and more, Danny.
Joe, really appreciate it. Joe Easton, we'll catch up with you later in the hour. Also coming up this hour, we'll discuss the Fed's decision to wait and see with our guests, Seema Shah, Principal Asset Management, and Priya Misra of JPMorgan. Principal Seema Shah weighed in on the Fed's rate path ahead, writing, quote, with inflation already running above target and expected to see tariff-induced boost in Q3 and economic data still looking fairly resilient, the current environment of persistent uncertainty is ripe ground for a policy misstep. Joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, great to see you this morning. A Fed that basically did nothing, elicited no market response. What are the risks for a misstep at this point?
Good morning, Danny. Well, I think that the key misstep would be, I guess, in either direction at this point, simply because there is so much uncertainty, not just on the trade front, of course, but also now on the geopolitical front. So, given that economic growth is still pretty strong, it's not really showing any clear urgency for rate cuts. And of course, then we have the inflation above target expected to rise over the coming months, both from oil prices and trade tariffs. Then it certainly makes sense that the Fed should be sitting on hold at least until they have a little bit more clarity about the path ahead. So certainly from our perspective, we're not expecting any changes from the Fed until you get later into the year, into Q4.
Even so, perhaps in a sign of the times, it was an extremely divided Fed. If just one of the Fed members had reduced their dot plot from 2 to 1, the average would have just been priced in for one cut for the year. Of course, the dot plot showed no change. Seema, is this a Fed that's maybe becoming less dovish, or at least is less dovish under the surface than the headlines would suggest?
Yeah, I think so. And I think that came through in the press conference when we were hearing from Powell. Given that their summary of economic projection shows a pretty significant spike in inflation over the coming months, I mean, from 2.1% now to around 3% by the end of the year, it certainly makes sense that there'd be a little bit more hawkishness leaking in. And, as I said, we are expecting just a cut to come through in Q4. That's just one cut. So it's certainly in line with where the committee is starting to shift. But right now, given the amount of uncertainty, it almost makes sense just to have everything staying on hold, both from an actual policy rate perspective right now, but also within the dot plot. They cannot give any really clear signal until they know exactly what the path ahead is going to be.
And anyone who knows what the path ahead is, Seema, needs to be a fortune teller because it is such a confused environment. One of the very decisive moves, though, with a market that's been stuck in a trading range over the past week has been oil. This month is up 20.5%. That's the most since COVID start 2020. But you have global stocks that are up nearly 1%. You have bonds that have returned 0.5%. Is crude playing a weaker role in global markets at this point, or are we just underestimating a very large tail risk?
Well, I think there's two key reasons why you're not seeing the market reaction to be very significant to the turmoil that's emerging from the Middle East. One thing is that although prices, as you said, increased pretty sharply in the past week, they're still significantly below the 2024 average. Right? It's still sitting below the $80 per barrel level that we saw last year, and certainly much below where previous conflicts have taken them. The other thing is that history tells us that geopolitical shocks, although of course they can be very significant in nature in the short term, they don't really typically have a very sustained impact on the market. The one caveat to that is when you do get a very meaningful increase in oil price to above $100 a barrel, it's sustained there, you get it feeding through to inflation. But that would be just reinforcing some of the concerns that we have today. So it's right that investors take notice, of course, and you want to have some safety within your portfolio, but actually trying to reposition portfolios to prepare for a geopolitical shock has typically been the wrong move for investors.
I do just wonder, Seema, it seems like we keep having shocks. And to some degree, they're the same flavor of shocks, let's say. They're politically driven in this political-driven economy. Does that overall dull the impact of when you get these headlines that, in theory, should and sometimes do move markets? At least we've seen that this year, but often their impact is short-lived.
I think there is certainly some fatigue setting in for investors in the past 5 or 6 months. I mean, there's so many hits coming from multiple directions. They're repeated. They're on a daily basis, sometimes intraday, that I think it does become difficult for investors to keep reacting. And so, which I think is the right decision, is to start trying to look through the noise, maybe take a bit of a 6-month longer term view and then position in that perspective. So when you're thinking about it in that way, I think it does make sense that stocks are a little bit higher. The risk outs are doing fairly well. Still, of course, with a lot of volatility. But if you are looking out over that 6-month perspective, you do feel some sense of optimism that the US economy, the global economy will ultimately be okay. Earnings growth will still be fairly positive. And therefore, you can still see positive returns for equities.
So just how bullish can you be on equities right now, Seema? Just how bullish are you?
We're overweight. I wouldn't say we're very, very bullish. We have pulled back a little bit, as I think everyone has in the last 6 or 7 months, as we've started to see concerns growing. And remember, from a growth perspective, coming into this year, the consensus forecast was that the US economy was going to grow by about 2.2%. That's now fallen to around 1.5%. So just with that downshift in growth, you have to have a little bit less optimism. That doesn't mean to say that we think that markets are not going to go much higher. But certainly the gains that we're expected are a little bit more constrained than what we've seen in previous years, and certainly what we were expecting to see at the beginning of this year too.
But even for the bond market, if this is a more volatile world, and specifically more volatility around inflation, Seema, does that not suggest that term premiums should be higher than they are right now? Is there not still a degree where this is a bond market that is priced for the great moderation?
I would actually say that when you're looking at 10-year Treasury yields, I mean, look, there's a ton of volatility, and as you said, there is certainly a chance that you do see risk premium, term premium rising. But at this level, this is fairly close to what we would consider to be fair value. I think the risk really sits at that 30-year point, and everything that you've mentioned with regards to political shocks, geopolitical risks. To me, all this is adding up to is greater inflation in the long term with concerns around fiscal policy. And to me, that really adds on to that longer term. So the 10-year point for us is okay. So you're looking at more of a shorter duration belly of the curve. The concerns really sit at that longer end of the curve. And again, that's not just for the US. That's actually a global narrative that we're starting to see emerge when you're looking across almost all countries.
So, Seema, and that's a great point. We even saw Japan announce that it was going to be pulling back on some of its ultra long-term debt today. Seema, so if the U.S. economy is looking solid and you can be more confident on that, if some of the geopolitical shocks, again, are short-lived, does it mean that that is the greatest risk fiscal, that a growing deficit is the greatest risk to this market right now?
I think it's a risk. I also think it's a risk which is going to continue to percolate over the coming months, quarters, and probably a couple of years as well, until it really gets to the point where the US government has to confront the very, very significant debt load that it has. So in the meantime, to me, the 30-year point hovering around the 5% level, range bound around that, certainly starts to make sense. I don't necessarily think that this is going to be a moment where the market really is facing a major fiscal crisis that would change the trajectory for markets over the coming years.
Seema, really wonderful to catch up with you on this week, on this Friday ahead of the weekend. Hopefully we get a weekend coming up. Seema Shah of Principal Asset Management. Let's now get you some other top stories that are trending on the terminal this morning. UK retail sales saw their sharpest fall since 2023. Sales dropped 2.7% in May, marking a reversal in consumer spending. The sharp drop was driven by a 5% plunge in food sales. PopMart shares slid in Hong Kong after a story in a Chinese newspaper called for the regulation of blind box toys and trading cards. The story in the People's Daily said some business models induce minors to become addicted to buying these products. PopMart sells the popular monster dolls Labubu. Temu's U.S. shares, I can't say that seriously. Anyway, Temu's U.S. shares decline has deepened. According to Bloomberg data, they dropped more than 25% from May 11th to June 8th. The online retailer has drastically cut ad spending targeting American consumers, signaling a shift in focus after President Trump's tariff announcement. Coming up, President Trump gives 2 weeks to make a decision on striking Iran. We're going to have more on the Middle East and Washington's positioning. That's coming up next on your Bloomberg Brief.
Over the next 2-3 weeks.
At some point in the next 2 weeks.
Nuclear, I'll give you 2 weeks for approval.
In about a week and a half, 2 weeks.
President Trump there giving 2 weeks in the past for talks, resolutions for varying scenarios, and yet again, we get 2 weeks. He has once again given himself 2 weeks to decide whether or not to strike Iran. Meanwhile, Iran's foreign minister said that it doesn't want to negotiate with the U.S. or anyone else while Israel's strikes continue. For the latest on the risks out of the Middle East is Bloomberg's Middle East Horizons Middle East and Africa host Jomana Bursechi. Jomana, what does the path for diplomacy look like right now?
Yeah, well, it seems as though the path towards the very worst case scenario has, or at least the decision towards that has been postponed. That 2 week window, as you say, could mean tomorrow. It could mean the end of 2 weeks, or also could mean much later on as well. But what the significance of those comments is that President Trump does indeed seem to be opening the door to diplomacy. And we know that the Iranian foreign minister, as we speak, is in Geneva meeting with his counterparts in Europe from Britain, France, Germany. They are ostensibly also talking about the nuclear deal. But at this point, it is unclear whether one of the takeaways from those discussions is going to be what terms would be acceptable to Iran in order for them to re-engage once again with the U.S. Because the Iranian foreign minister just a short while ago said that they're not willing to restart talks as long as Israel keeps striking. So how the U.S. administration sort of navigates that and whether they can apply pressure on Israel to slow down the intensity is a big question as we think about the diplomatic channels. But in the meantime, the tit for tat, the attacks and counterattacks between Iran and Israel continue. Israel continued to strike at key military sites, nuclear sites, and Iran yesterday struck at an Israeli hospital that caused the number of wounded, resulted in a number of wounded of north of 200. In response to that, the Israeli Defense Minister, Israel Katz, has once again sent a message to the supreme leader saying that they will strike back and will not spare him this time around.
Jomana, there was also some reporting on two various lawmakers in Iran threatening a closure, something that looks like a closure in the Strait of Hormuz. What are the risks that we could see something of a disruption that impacts global oil markets?
Yeah, I mean, I think at this point, most people are familiar with the strategic significance of the Strait of Hormuz. Obviously, about 20% of the world's oil and gas passes through that very key waterway in the region every single day. And Iran has for long used it, the threat of closure as a means of deterrence to the West. Now, some of the more hardliners in the Iranian regime have been speaking the last couple of days. The former economy minister saying that Iran should shut the waterway and block vessels from passing, but they haven't actually gone down that route. And you have to remember, Danny, that for Iran themselves, it is a key way for them to get their own oil exports out because their key buyer is China. So they also need their vessels to continue operating to offload some of that oil. And interestingly enough, the data that has been compiled by our team has shown that Iranian oil exports have actually increased in the last 5 days, which suggests that they're trying to get a lot of their exports out in anticipation of a potential disruption. Shipping costs also a lot higher, anything between 50 and 100%. So people are very cautious.
Jomana, thank you so much for your excellent coverage all week. That is Bloomberg's Jomana Bersetchi. A check on Brent crude as we head into the break. Lower this morning by more than 2% after a similar move higher yesterday, with weekend risk taken off the table, at least for now, again, with Trump saying 2 weeks is his decision timeline. Oil, though, higher by more than 20% over the past month, for the biggest month since 2020. Coming up, SoftBank's big bet. More on Masayoshi Son's $1 trillion AI pitch. That's coming up next. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. What's making headlines in the top outlets? First up, on the Financial Times, they lead with European countries holding talks with Iran. Those talks set to take place today, Friday, with Britain, France, and Germany. They will be taking place in Geneva. Next up, on the Washington Post, a federal appeals court has ruled that President Trump can keep the National Guard in L.A. A three-judge panel decided unanimously in favor of the president. Two of the judges are indeed Trump appointees. And finally, one of the most read on Bloomberg this morning, we have learned that SoftBank founder Masayoshi Son is looking to team up with TSMC. It could be his biggest bet ever. The plan is a $1 trillion industrial complex in Arizona to build robots and artificial intelligence. For more, let's bring in our technology reporter, Minjung Lee, one of the authors of that Bloomberg scoop. Minjung, first of all, excellent work. What more do we know?
This would be another completely new business for SoftBank and Masa Son. One reason being it could have a strong hardware feature, which would be new for SoftBank, which has been always focused on software. And Masa Son is just in the process of toying with a bunch of big bets. And now we know this manufacturing AI hub is the more prominent one among them for now. But there's a lot of things that need to be figured out, including which companies will actually come on board, as you mentioned, whether it would be TSMC or not, because SoftBank doesn't really do any manufacturing itself. So the entire mix and capacity and the shape of this industrial park complex would really depend on which companies join hands with SoftBank. So basically, which companies that Masa is able to win over with his charm. So we'll see how it unfolds from here.
Minjung, it's been a period of just incredible spending by all of the tech giants on AI. What does it tell us about their desire, SoftBank's desire, to keep up with the likes that we've seen from Meta and others?
Right. Masa is really now coming out with one big project after next to really have his name out there and push forward with AI developments. With what we know, he already has 3 big projects in the works based on our reporting. This includes the big chip project. Chip is an Aggie project that is being led by the chip unit arm. And the other one is, as we all know, the Stargate data center project with OpenAI. And now, as we've learned, there's this new big Arizona AI manufacturing hub in the works, which would be backed by Arizona government officials. But it's really still very early days, and Masa is trying to kind of rebuild his legacy after the Vision Fund kind of didn't quite live up to his expectations in terms of returns and outcome. So we'll have to see which, if any of these projects will end up being the real cash cow for SoftBank and Masa.
Minjung, just quickly, only a minute here. What does it say about the politics of this moment? President Trump very keen to have people come into the U.S. and build this type of thing.
Right. He's really being very smart about playing really into the needs of Trump in America. And with this manufacturing hub, one of the pitch includes that this, if successful, will bring all the manufacturing power back to the U.S. With a particular focus on Arizona. And if this model is successful, he's pitching that this could potentially be replicated in other states as well. So we'll really have to see how it unfolds from here, though.
We absolutely will. Minjung, again, excellent work with that scoop. That is Bloomberg's Minjung Lee in Tokyo. Coming up, we're going to wrap up the big week of central bank decisions and a lot of risk on the horizon. JPMorgan's Priya Misra joins us next on your Bloomberg Brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday morning. We start with geopolitics. Trump giving himself a 2-week deadline for a possible strike on Iran. Next up, a $1 trillion pitch. SoftBank founder Masayoshi Son teams up with TSMC for an AI mega hub in Arizona. And the big reveal, Tesla set to launch robotaxis in Austin this weekend as lawmakers attempt to block the operation. It has been a roller coaster of a week for Brent crude, but by the way, on the month, we are up 20.5%. That will be the biggest month since 2020. You can see the past 2 days, the U.S. was closed, but Brent crude runs up. And this morning, we get a drop of about 2%, a little bit more than that, leaving the past 2 days just a little bit higher, with President Trump saying that he would take 2 weeks for diplomacy to make a decision. Your S&P 500 futures session, again, traded a little bit yesterday. It is weaker this morning, but not as weak as it was yesterday, down about 0.2, about 1/3% for the NASDAQ. Meanwhile, treasuries, they have been waffling between gains and losses this morning. We continue with slight losses, but basically unchanged. 4.39% is where we stand on your 10-year yield. Let's get you some stocks to watch this morning. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Tesla gaining today, as you mentioned a moment ago. It is all about these robo-taxis and whether or not they will actually launch next week over in Texas. And it does come as there is some pushback from some senators, a group of them saying that they want this to be delayed due to safety concerns. Here's that quote from them on the screen here. The Senate and the House members formally requesting that the robo-taxis are delayed. What can go wrong with self-driving cars? But moving on to the DIY space, a bit of a bidding war potentially for a company called GMS. Home Depot coming in, according to the Wall Street Journal, actually looking to make a rival bid to another firm, QXO, who had bid around $95 for GMS. So we could see that one jumping at the open. We're up 20% on GMS in the pre-market. So lots of focus on DIY home repair this morning. And then finally, one more to bring you, the firearms maker Smith & Wesson jumping as well in the pre-market as the sales. Excuse me, I've gotten that completely wrong. I've had a right mare on that one. It is down 13%. The stock had rallied into the results, but actually missing on EPS. I think I need to update my data. The stock declining after a decent run recently. Keep an eye on that one in the pre-market, Danny.
And Joe, with that, I will say happy Friday. Go enjoy your weekend. I think it is time. Joe Easton there. It's been a week for all of us. Even with yesterday off in the U.S., it was a busy week of central bank decisions. JPMorgan's Priya Misra playing down the latest Fed outlook in the SEP, rightly so, saying that the projections reflected a stagflationary bias, that the goals are in tension. But the summary of economic projections matters less since there are many unknowns: trade policy, fiscal policy, geopolitics. Joining us now is Priya Misra, portfolio manager at JPMorgan Asset Management. Priya, great to see you on this Friday.
Hi, Dan.
And look, amid all of those risks, the Fed was able to kind of do nothing and get no market reaction at the same time. Is that what success looks like in 2025?
I think for the Fed, that they're in such a difficult position. They've got this stagflation issue. They've got elevated uncertainty. I think Chair Powell said it's less than it was in May. It's still very high. So, and inflation's still above their target. So I can see why the Fed probably wanted to take the day off on, Wednesday, but they had to come out and say something. I think what we're looking for is the sense of the reaction function. And we didn't get much from the Fed. I looked at that dot plot. Now, I know that there were these, the median still showed the cuts, but there's these two camps. There's the camp of the people who don't want to cut at all this year. I think they're the ones who think that inflation might be persistent, that the rise due to the tariffs might exist all year, so you don't have to cut. And then there are those who think it's going to be transitory. And I think we're going to have to wait for the data. And that's what Chair Powell tried to say. He downplayed the dots. So I think it's the stagflation issue. It's high uncertainty. It's the Fed saying, not my problem yet. I think what was interesting was there's this concern around the labor market, and Chair Powell tried to downplay that. Now, I think that's what we're going to be watching, the growth data as well as the inflation data. The Fed is more focused on inflation, but I think the market's going to focus on that labor market report as well.
Is there kind of an irony of having such a divided Fed, such divisiveness on the dot plots, and at the same time, you had their statement saying that there was less uncertainty, even though there was still uncertainty. Is there a bit of a contrast there?
I think it's all relative. So relative to May, there was less uncertainty. But to your point around the divisiveness, I think it's because look at the levels of uncertainty here. Not just in terms of trade policy. I think Chair Powell tried very hard not to talk about fiscal policy. But we've got the one big beautiful bill also going through. We've got 2 weeks for that, for their self-imposed deadline, which I really struggle to see how that will happen. But over the next few months, we're going to get changes in fiscal policy, changes in trade policy. I mean, even if you leave geopolitics aside, deregulation. And so I think the Fed is saying we have to look at the big picture and see how the economy is responding and then take a call. So I think what they're telling us, if you read between the lines, is they can't be preemptive. So I think this idea of insurance cuts or the Fed trying to get ahead of what might be happening, that's not happening. I think the market has to be aware of the fact that there's no Fed put here. They will absolutely respond if there's clear economic data, but it's not clear right now. The economy is resilient and inflation's above target.
By the way, a great reminder that the start of July is also going to be crazy because we have both the trade deadline and the big, beautiful bill self-imposed deadline, both self-imposed to some degree. Okay, so with all of that, how do you even begin to understand what is and what isn't priced into the bond market?
Great point. So let's look at the bond market in terms of the Treasury curve as well as spreads, credit spreads. So on the Treasury curve, I think that's where it's interesting. Those all-in yields, if I add Treasury rates to spreads, credit spreads, we're looking at good level of yield. So if you think about what do bonds add to a portfolio, they're giving you income. Now, the question about do they give you diversification if risk assets struggle, I think the intermediate part of the Treasury curve does give you that. So the market is pricing in some rate cuts, but not aggressive. The first rate cut is really priced by September. And I think that's the market saying, what if things slow down? We know that tariffs are likely to increase inflation, and the Fed sort of told us that, even though the inflation readings have been positive, that's going to affect demand. And so if the economy slows down, we know the Fed will respond. So those rate cuts in my mind are not overdone. I think the market is correctly pricing in this tail risk that the Fed might have to cut more. So I don't think the rates market is pricing in, too many cuts. And then we look at spreads, and I know you're going to say those spreads are tight. They're tight for good reason. Companies look strong in terms of balance sheet, in terms of earnings. And so those spreads are tight, but fundamentals, technicals, we're going to get a lot less credit supply over the next few months. So, we like, credit products here. We like owning bonds. We're still seeing inflows into bond funds as people are looking at 5.5%, 6% on investment grade corporate, 7% if you go into high yield. And they're saying, actually, given all the uncertainty, let's look at getting some income and the hedge property in the 5-year sector in case the economy does slow down.
So you mentioned there's less supply in corporate bonds, more supply, assuming what happens with the big, beautiful bill is what happens for government bonds. There's maybe more sources of demand coming. You had the stablecoin legislation that basically mandated that these dollar-pegged stablecoin issuers buy more shorter-dated treasuries. You have SLR reform, too, allowing banks to hold more. Does it move the needle at all? Does it maybe, if what Washington's goal is to create more demand, actually do that?
I think there's some sources of this domestic demand, to your point, coming in. the curve has also steepened. So that term premium that we look at, which is how much additional yield are you getting from extending out in duration, that's gone up. So the market is pricing in this fiscal risk that we all know about. It's the trajectory problem. I think that's priced in. And then there's tariff revenue. The CBO projected 2.8 trillion in tariff revenue. Now, we have to still see what tariffs will end up. But I think if you're going to get 10 to 15% effective tariff rate, you are getting revenue from that side as well. So I think much is made about the deficit, rightly so. I think we've got a long-term trajectory issue. But to your point, there's sources of demand. The market's pricing some of it in the steepening. So we're less negative in the long end. Do I think that the long end will be what it was for the last few decades, where it was a source of diversification? Less so now. But I'm less worried about the very long end now, because to your point, that's happening. And the Treasury, we're going to be watching what Treasury does. We saw what the MOF is doing in Japan. They're reducing the amount of issuance in the long end. I think the Treasury might be next. Maybe not as early as the August refunding, but over the next year, I think they're going to issue less.
But isn't that something that like emerging markets do, that they cut their, or they don't even issue long-term bonds because there's no demand for it? Is that not in itself kind of concerning?
No, I think the Treasury, I'll give the Treasury credit, and it happened in 2023 as well. The Treasury as an issuer should look at where is the demand and let's issue supply to meet it. And I think there is more demand in that front end between banks, as you point out, stablecoin. Look at the 7 trillion sitting in money market funds. That's also sort of short-dated demand. Mutual funds, the index is a 6-year duration. So I would say Treasury should skew issuance in the front end. We still have to deal with, they have to issue it. So we still have to deal with the longer-term deficit trajectory, and let's see how this OBBBA, as I call it, not the triple B rating.
Yes, okay, noted.
It's in the name, but, we have to see what that ends up. But the Senate version is not much more than the House. Actually, it's less deficit. We have to see what the CBO is going to score it. But I think there's understanding in Congress, in Washington, that we have a deficit problem. And that's why they're trying to cut back wherever they can. And the market's pricing that in. So I think it would be smart for the Treasury to actually skew some of that issuance in the front end.
So the one BBB, the one triple B. Not the credit rating, but yeah.
Curve is still AA.
Priya, thank you so much for joining. Really great to see you. Enjoy your weekend. That's Priya Misra of JPMorgan Asset Management. Let's now get you some other top stories that are trending on the terminal this morning. As Priya was mentioning, Japan plans to cut its super long bond issuance this year by more than what it had earlier reported. The finance ministry is proposing reducing issuance by 3.2 trillion yen. That's about $22 billion through the end of March 2026. Markets were expecting a reduction of 2.3 trillion yen. Pop Mart shares slid in Hong Kong after a story in a Chinese newspaper called for the regulation of blind box toys and trading cards. The story in the People's Daily said some business models induce minors to become addicted to buying these products. Pop Mart sells the popular monster dolls, Labubu. Temu's U.S. sales decline has deepened. According to Bloomberg data, they dropped by more than 25% from May 11th to June 8th. The online retailer has drastically cut ad spending targeting American consumers, signaling a shift in focus after President Trump's tariff announcements. Coming up, the clock is ticking on a potential diplomatic resolution to the Middle East. President Trump gives 2 weeks of a decision time to decide on striking Iran. We're going to have more on that next, and a meeting in Geneva. This is Bloomberg.
I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks."
President Trump setting a deadline to make up his mind on the Israel-Iran conflict. Meanwhile, Iran's foreign minister says that the country does not want to negotiate with the U.S. or anyone else while Israel's strikes continue. Joining us with the latest is Bloomberg's Oliver Crook. Oliver, it does seem like there are going to be some sort of negotiation, though. European leaders are set to meet with Iranian counterparts in Geneva. What's likely to be the outcome if Iran doesn't want to negotiate as long as strikes are continuing?
Yeah, so let's lay this out in terms of who is meeting whom today. So it's going to be the Iranian foreign minister arriving in Switzerland, Geneva, and speaking with the foreign ministers of Germany, the United Kingdom, and of France. We'll also have the EU High Representative Kaja Kallas involved in some of those discussions. And the idea here, Danny, is to begin to start to talk about basically the framework, the architecture of what a sort of nuclear program monitoring system could look like if there is a ceasefire, if there is some kind of peace, one sort of step to diplomacy. As we heard there from Caroline Leavitt, Donald Trump is trying to give some runway, apparently, to diplomacy over the next 2 weeks. But as you point out, Danny, in order to have diplomacy, you need to be able to talk. And the Iranian foreign minister said that he will not talk to the United States while they're bombing, the Israelis are bombing Iran. So that does leave a little bit of space for the Europeans to come in as basically part of the communication team and potentially relay information over to the United States. Now, we should say, as far as the Europeans are concerned, they have limited clout diplomatically in the region, over Iran, over Israel. We know that they don't have really very much leverage over those two, but they could serve potentially as a sort of communication vessel between what the Iranians are looking for and speaking over to the United States. That being said, I think it's very unlikely that you get a grand proposal out of this meeting today, because as we know, Danny, it's really the Trump administration that wants to author how this is going to go and sort of present this. They're not going to want to jump on whatever the Europeans have negotiated. So that being said, I think that the Europeans could be potentially useful in terms of a form of communication. But we should say, Danny, yet again, this is another example of, in the world of Trump, how the Europeans are really going to be spectators rather than protagonists in geopolitical conflict.
Well, can we also just emphasize, Oliver, how different the language coming out of European leaders, the likes of Emmanuel Macron, has been versus Trump? It seems like they've been talking about de-escalation, while Trump has gone back and forth as to whether that's the case for the U.S.
Yeah, and Trump, I think that is part of his tactic, right, is to create strategic ambiguity, to say, we could do this, we could do that. Nobody knows what I'm thinking. This is what he's been saying, over the last 24, 48, 72 hours. And that is really sort of the impression he's been given. And frankly, it's been successful, right? Nobody really does know what he's thinking. And I think as a consequence, the Iranians don't really know how to sort of calculate what the U.S. is willing to do here. Again, the Europeans, generally speaking, will always be saying diplomacy first, we need to de-escalate. That being said, Danny, there has been basically zero criticism of the Israelis from the European side so far. We should say that the tone has really turned in terms of criticism of Israel in terms of Gaza over the last couple of weeks and months. But in terms of Iran, the Europeans have been, frankly, kind of tacit in their sort of criticism, no criticism at all, tacitly really supporting what the Israelis have been doing in terms of their campaign in Iran.
Oliver, thank you so much for that excellent coverage. That is Bloomberg's Oliver Crook. And we are getting a few lines coming from the French President Emmanuel Macron at the moment, saying that nothing justifies Israeli hits on civil infrastructure, urging Iran to return to the negotiations table, saying that the UK, France, Germany will present a proposal to Iran today. Again, that is ahead of that meeting Oliver was just describing in Geneva, Switzerland. Let's turn to tech now. TSMC ADRs are edging higher in the pre-market this morning. That's as Bloomberg learned that SoftBank is looking to team up with TSMC in what could be its biggest ever investment. Joining us now is Bloomberg Tech Europe anchor Tom McKenzie. Tom, what is SoftBank's aim in this?
The ambition is there, Danny. $1 trillion is what Masayoshi Son and SoftBank are thinking about in terms of a potential industrial base, automated, with a focus on AI in Arizona. The kind of plan that you look at Shenzhen in southern China and think, if we could lift that and replace that and move that, or at least duplicate that, I should say, in the US, this is the kind of vision that SoftBank is looking at. It is hugely ambition. And they have reached out as part of that ambition, as part of this touted plan that, by the way, they've had conversations with local and state officials, but also the Commerce Secretary Howard Lutnick as well. They've reached out to the likes of Samsung. They've also reached out to their own portfolio companies to see if they would want to have a role in this industrial, highly automated industrial space with that focus on building out AI-embedded robotics, for example. Big questions, of course, in terms of how you actually pull the money together for this, given that TSMC itself is already committed, Danny, to investing about $165 billion in the US, a lot of that going to its foundry that's being built currently in Arizona, and, of course, the financial commitments that SoftBank and Masa already have.
I was going to say, Tom, I'm guessing it's no coincidence that this is a pitch for Arizona, that it's a pitch for the U.S. What does it underscore about the politics of the decision to invest what SoftBank hopes is $1 trillion in this AI hub in the U.S.?
Well, it ticks a box, doesn't it? It hits the sweet spot for President Trump. This is high-tech, high-end manufacturing that is being envisioned here, being sourced and built and produced and put to use in the United States. The question is, of course, can you find the staff? Can you find the engineers? Can you find those to build, but also operate these plants? That's the question, along with the financing. You would need to get those tax breaks, presumably at that state level, potentially at the federal level as well, in order to help offset some of the cost. SoftBank already has committed to about $30 billion in terms of its investments into OpenAI. It's in the middle of going through a transaction, spending about $6.5 billion to buy up Ampere. It's got its investment promises around Stargate, and it's got about just $23 billion in terms of cash on its balance sheet. So clearly SoftBank will need its partners and will need tax breaks and will need financing from private sources as well to get to this $1 trillion number that is currently being touted. So still a lot of questions to be asked as to how do you actually get this feasible, make it feasible, but clearly it really underscores SoftBank's ambitions, particularly in the US, to align with that priority and with the Tsar, the AI Tsar in the US and President Trump himself.
Tom, thank you so much for bringing us that. Tom McKenzie there. And by the way, so pleased to say that you can catch Bloomberg Tech Europe, anchored by Tom, every second Friday of the month at 6:30 a.m. London time. There was one this morning, which, by the way, you should go back and watch that on Bloomberg.com. The next episode airs on July 11th, in which Tom will have an exclusive interview with SAP CEO Christian Klein, a conversation you don't want to miss. Elsewhere in the world of tech, we are also keeping an eye on Tesla this morning. Shares up more than 1%. The EV maker is tentatively set to launch its robotaxi in Austin, Texas this Sunday after CEO Elon Musk posted on X at the start of June about the rollout. Democratic lawmakers, though, from the state have signed a letter to Tesla calling for further safety demonstrations and a delay to this rollout. For more, Bloomberg's Danny Lee joins us now. Danny, deadlines for Tesla for Elon Musk tend to always be a little bit squishy. What are we expecting this weekend?
Yeah, I mean, Danny, we're just days away now from the launch of Tesla's self-driving car service in Austin, Texas on Sunday. And all the enthusiasm has been tempered a little bit by this call from the opposition state Democratic legislators calling for a delay in the rollout of the robotaxi service to at least September 1st. And September 1st in Texas would be where a whole range of beefed up self-driving laws kick in. At the very least, the Democratic lawmakers want to see commitments from Tesla that the kind of self-driving launch that there would be compliant with the laws that come into effect on September 1st. But these kind of calls would kind of fall on deaf ears, given the Republicans control a lot of the politics in Texas there. But this robotaxi rollout is going to be very important. This could very much mark the comeback for Tesla, given all of its struggles over the past several months, and particularly as Tesla focuses on artificial intelligence and on automated driving, autonomous driving. And so with Elon Musk back at the helm, he's got a lot to focus on, particularly to try and revive this global sales slump from China to Europe. And so with that all on its plate, it'll be a big focus to see just how well they can do, even though this rollout of the robotaxis in Austin, Texas, in a small, confined part of Austin, may involve only 10 to 20 cars, as Bloomberg has reported. So it's very much a watch and wait and see in this space.
To that point, Danny, I mean, Tesla shares are still down, 20% so far this year. What does the battle look like for robotaxi domination? They're obviously coming behind that of Waymo. How important is it to them to get into this market and gain some market share?
Yeah, I mean, Tesla clearly behind various competitors at the moment, but its ambition, given it has a huge fleet of cars, full stop, of EVs, the ambition is to merge or combine the idea of having this Airbnb and Uber-style service to be like this car ride-hailing app pickup. So it has a lot of ambition to be global, and it has the positioning. So it's whether it can crack this kind of very initial launch. And so the ambition is very much there. Just wait and see how successful it can be in a short term and a long term.
Yeah, we'll see what this weekend brings. Bloomberg's Danny Lee. And again, we are expecting that this weekend. Tesla shares, though, down 20.25% so far year to date. So it has some catching up to do, to Danny's point. Okay, let's get you set up for your day ahead. It is Friday after a holiday shortened week, but we are going to be getting some results. We are going to be getting some CarMax, Kroger, Darden restaurants. All those report before the bell, so you might get kind of a view on the consumer after retail sales materials earlier in the week, if you can remember that was indeed this week, showing weakness on the headline figure. But for the control group, there still was some strength there. We'll see what some of these industries are saying. Plus, we'll also get numbers for the Philadelphia Fed business outlook. That comes at 8:30 a.m. Eastern. And as we were just discussing with Danny Lee, we will be getting Tesla launching its robotaxi. That comes in Austin, despite some pushback from local lawmakers. Meanwhile, some movers in the pre-market. We are seeing Circle. This stock has been up all this week. It is extending gains after the Senate passed a stablecoin bill, which, by the way, we're talking with Priya Misra about this. The stablecoin bill is part of it. If you are a dollar peg stablecoin, you also need to buy like-for-like Treasury reserves on the front end of the curve. So it is also a way from Washington to create Treasury demand at a time when there has been concerns about a global buyer's strike. So how much of that will come in? Scott Besson says it will be a $2 trillion market cap. So that assumes $2 trillion worth of demand. GMS, that is Home Depot seeking to buy GMS and challenge to QXO. You are looking at Coinbase shares, though. There you go. GMS shares up 23.44%. That is a report from the Wall Street Journal. Finally, CarMax. Again, you're looking at General Motors there, but CarMax, they will be reporting results this morning. So just take a look at the automaker. Shares are down 20.7%. All right, as we head to the end of the hour, a quick check on your markets this morning. S&P futures are weaker this morning, down by 0.2, just about of 1%. The dollar continues its downtrend with 10-year yields. Little change this morning, but the bigger move is oil this morning. It is dropping after President Trump said that they would take 2 weeks. He would take 2 weeks to make a decision on Iran. So oil down more than 2% this morning after yesterday in the holiday U.S. trading break. We did have WTI close, but Brent crude gained by a similar amount. That is it for your Bloomberg Brief. Surveillance coming up next.